All right. So today we're going to continue with where we had left off last time. We're supposed to look at market structure. We had a Zoom meeting about it, but I don't seem to find the recording. So I'm making this one basically on market structure, what we did last Sunday. So when you're talking about markets, we have three types of markets. The first market is a market which looks like this. Now, this is known as an uptrend because the market is moving upwards. So this is called an uptrend. Then the opposite of this is a downtrend. And I'm sure by now you can guess how it looks like. So it's a downtrend. Just be opposite to start with the top going down like that. That's a downtrend. Then the last type of market is known as a consolidation or ranging market. Now this type is where you have a market moving within a specific range. It doesn't go neither up in a specific trend or down in a specific trend. It just ranges or it moves within this boundary. Yeah, within that boundary. So these are the three types of markets. Then we need to like focus on the distinctions of these types of markets. Now, as you can tell, the the uptrend is just the opposite of a downtrend. The only one which is different is the ranging market. So if I was to go back down real quick, yeah. So this is the example of an uptrend. Now, an uptrend is distinguished from the other market types because it forms higher highs and higher lows. Now, in case you are confused with what this means, what this simply means is when the market made an impulsive move upward to that direction, this is the highest point that reached before it retraced back down. So this is a higher high because it's compared to the previous high the market had made. So this is higher than that high. So that makes sense for it to be called a higher high. Same scenario here when the market moved from that came to this level here. That's the highest point the market had moved before it retraced back down. So this is called higher high because it's higher than that level there. That level. Hence, it just makes sense that it's called a higher high. Now, the same scenario also applies to these higher lows. So, if you look at this low here, it's a low in itself because when the market was making a pullback, this is called a pullback or a retracement. When the market made this retracement, this is the lowest point the market came before it went back to that impulsive move. So this is referred to as a higher high. Why? Because it's higher than, or it's referred to as a higher low because it's higher than the previous low, which is this one here. Then this also makes sense that this is going to be called a higher low because it's higher than this previous low. Yeah, so let me just erase this real quick. So then you're going to see the significance of what we are doing later on when we start looking at support and resistance. So if I was to now scroll down, hope it's clear on an uptrend. Let's go down to the opposite of it, a downtrend. Now for this downtrend, you notice that it has different names. By the way, if I go back here, you don't really need to focus on these names like higher highs, higher lows. If you confuse them, it's fine. What you just need to understand is the concept. Like if you remember my first drawing of an uptrend, something like that. So this is the concept you're supposed to have. Whatsoever other names you're forgetting, it's perfectly fine. If you can remember the concept, you're good. So this is the same thing which applies here. A downtrend, you have an impulsive move downwards. And what I mean by impulsive move, an impulsive move is just a strong move in the direction of the trend. So since this is a downtrend, which of these is going to be an impulsive move? You can see this is pointing upwards. That's not in the direction of the trend. The direction of the general trend is downwards. So the moves that are directly going downwards, like this move here, is referred to as an impulsive move. Even this other one here, that's also referred to as an impulsive move. You also have this one here on top. Then these smaller ones are referred to as retracement or pullback. We'll also look at the significance of them as well. So now that we are clear, oh, this also applies for an uptrend. If you're going upwards like that, then these will be the impulsive moves because they are moving with the trend. Then this one, then these two smaller ones here, this one and this other one here. They are referred to as retracements because they are moving in the opposite direction of the overall trend. Hope that makes sense. Then let me see if I can. Let me just erase this real quick. And we go back to where we are now. So hope that will now be making sense as we proceed. Yeah, so here you have this impulsive move. Then there's this minor retracement going upward. Then we had another impulsive move coming down. We can ignore this minor retracement here. We just go direct to this bigger one. Then we have this retracement, we have that major move. Now, these are called lower highs because, for instance, this is a high in itself, but it's lower than the previous high, which is this one. So it makes sense that this is called a lower high because it's not higher than this previous high. These also at the bottom are referred to as lower lows because if you go to the next one, it will be lower than the previous low. Let me read this to make things a little bit more clear. Yeah. So I was saying, for instance, this will be referred to as a lower low because it's lower than this previous low that the market had made previously. Also, this is lower than the previous low that the market had made. So this is lower than the previous low that the market had made. So if we are clear on that, we can now we'll look at the significance of this. We'll look at the significance of these when it comes to support and resistance. So basically, that's what makes up a downtrend. Now, when you come to a trending market, this is just what I was explaining. And if you think about it, the overall direction of the market is upwards. So we expect impulsive moves only to be moves that are in the direction of the market, like this one here. And you notice that impulsive moves have big momentum candles. as in compared to the retracements, which are most often small bodied candle, meaning they don't really have a lot of momentum. So an impulsive move, the other thing to keep in mind is since they have big candles, they move very fast. Retracements have like smaller candles and they're very slow to form, but momentum moves take off very fast. Hence the name impulsive moves. Now we can move on. Yeah, I think I had explained this when I was talking about downtrends. Now we can move on to, yeah, so this is just an example. The one we were looking at previously, this one. These are examples of impulsive moves and retracement to an uptrend. So as you can see, we had that, then it was moving up using those levels that we've looked at. Then we also can see the same with the opposite of this, which is just a downtrend. Now for this one, it's the same concept, but since the overall trend is going to the downside, you can think of this as impulsive moves will be what are in line with the trend. So like this move here, where this one, where this other one there, and that one. Then in between we have this minor retracement. And those are also important, as you will see when we're looking at support and resistance. Let me remove this. Yeah, so the first example is on an uptrend. So if you remember from my explanation earlier what we've been looking at, you will notice something here. If the market is moving upwards, it makes this small retracement, goes up, then it makes these retracements up. Then these are not like random as someone might think. Why am I saying they are not random? Because if you look at these levels here, the level like this one. Okay, for instance, what I've just drawn. Let's focus on what I've drawn. I was saying the retracements are not just random, meaning they are always moving back to the previous level where they had failed to break that level. It always comes back. So now, before we can even continue, let me explain something else. Let me explain something else. If, for instance, let's say you have that line, right? And let me put another line here. Okay, yeah. So the bottom line is referred to as support. Then the top line is referred to as resistance. Now to put things, I'm trying to just write them line. Now to put things in perspective, the market is in an uptrend moving upwards like that. Then it comes to, let's say it goes up like that. Then it comes back down to that level. Then goes back. Then goes back up, then goes back up there. What the market is essentially showing us is this. When the market came to this level here, that point is referred to as support because it was pushing the market or helping the market move or supporting it to go upwards. But previous level we had this one, it's referred to as a resistance. Why? Because in short, resisting just means preventing something to go any further. Yes, so then this level was acting like as a barrier, preventing the market to move any further and putting it back down to that level, to our support level. Now, these are formed at levels. Now we can go back to what I was explaining. These always form at these levels where the market will be making. Those levels I was talking about always form near the previous higher highs. If you're looking at it from the perspective of an uptrend. So you notice that whenever a market makes a high, like it fails to break that level will be referred to as, the level is going to be referred to as a resistance level. Why? Because these are the points where the market had difficulties, or that's where they've encountered the barrier, failed to like go above it. Hence, these become the areas that we'll be looking out for because we know that the next time the market goes there, it's going to have challenges breaking it, going to the upside. So then you look for stochastic combinations at those levels. Now putting things in perspective, let's go back real quick to this thing we're looking at. Let me erase this. Now if you pay attention to this, you'll notice that this is an uptrend, your impulsive move where it stopped, then it comes down, goes up, comes back to this level. Now this was previously a resistance level because the market failed to go any further from there. It had to like come back down. And when it broke that level and came back to it, this resistance changes its name to a support level. Once this happens, you expect the market to do what? Move upwards. Hence, if you are now a trader, you realize that this happens every time because if you can see just where I am here, you are this resistance level and the market came down, broke that level. The level I'm talking about is this red line. Then came back to retest it or came back to that level, then went up. Meaning, as a smart trader, what you'll be doing is you'll be drawing a line. Let's say if all these things haven't yet happened, you draw this line where the market had failed to go beyond. Hence, you'll be waiting for it to break past that level and for it to come back to this level. Once it does, you know that you'll be trading going upward. The same happened here. The level where it had failed to break, which is this one, once it goes to break it, you draw your line. Then when the market goes down for a short retracement and breaks that level, you'll be waiting for it to come back down to that level. Once it does, you trade going to the upside. The same thing happened here. Where it had failed to break there, you draw your line. Then where it is now, once it comes back to this level, you trade. This also shows the concept of break and retest. Now, break and retest just mean exactly what I've been explaining, though I didn't give it a specific name, but that's the exact concept of a break and retest. So a break and retest just means once you see that the market has moved, yes, you see this impulsive move, which is it has to go beyond that level. So it starts going back down. You draw your line, then you wait. Then the market breaks above that level. That's the first concept in the break and retest. So once it breaks it, it always almost goes back to that level. That is this level I'm referring to. It just goes back, retest it, and go back up again. So there was a break at this level. Then the market went back to retest this level. This is referred to as a retest because at some point it had failed to go past that level, or it had already touched it in some previous instances and it has gone back to that level as again, hence bringing out the idea of a break and retest. Hope that makes sense. Let me give another example. For instance, if we are starting from here, I've seen that the market had failed to go past that level. So I put a line, then under break and retest, I know that I have to wait for the market to break past this level or the line I've drawn, which is the resistance level, because the market had failed to go any further from it. Once it breaks it, I wait for the market to come back. The name of this line changes from resistance to support. Hence, once it comes back to this level, that's my retest. I'm anticipating that it's going to go up. So I trade from this level here. Hence, break, retest, then it continues with a move. So I can now remove those. This is the same concept for downtrend. You notice it will make a break, retest, it continues here. Then there's a retest and it continues, break, retest, and it continues. So your entries will be at these levels. How do I know? Because previously it was a key level, the market had failed to go beyond, failed to break that. So when it broke it, I know for a fact that using the concept of test and using the concept of break and retest, after the market breaks that level, it automatically go back to that level, test it one more time, and continue. So this happens also for a downtrend. So let me just erase this. If that makes perfect sense, we can come to trends. So now trends are just points that connect a certain market move. So for instance, let me start with an uptrend since it to be easier to understand, to grasp. Yeah, so with this one, as I had said earlier, right, these levels, the retracement move in a specific order. They're not just random like most people in the pen charts for the first time. You just think things are random, they're not. So these are the specific level where if you are to draw a line, you can actually connect those points. What I mean is, if the find the white sheet, what I mean is, you see the market moves like this, right? Makes us now minor retracement. So makes that, makes that, goes, makes that. So what I'm saying is, these retracement levels, they're not as random as most people think. Why? Because if you are to draw a straight line, you can be able to connect all of them perfect, which is now the example that we have here. Let's start with this one. You'll be able to connect it perfect. Now someone might ask, why is this important? It's important because once you're able to like connect these perfectly, you'll be able to anticipate what's going to happen. For instance, if I was to say, I've seen that this level, when it touched this line, it went up, then it came back again to this level. Then once it touched this level, what did it do? Went up again. It's a minor retracement, don't consider it. It went up to that level. Once it reached this level, what is it doing? It comes back to this level. So already here, I'll be anticipating that this is going to go up, and my trade for a buy is going to be at this level. Then I can combine this with confirmation from one. I can use what we were just from looking at, support and resistance, because I know this was a previous support level. This one will show you. Okay. This was a previous support level. You can look at it. Same, right? Now I know that I have two confirmation. I have this confirmation, which shows that once the line is touched, the trend line, the market is moving upwards. Next, this was a previous support, which was broken, retested, went up and retested again, forming a pattern known as a double bottom from here, hence going upwards. So now this gives me even more confidence in the setup. Yeah, then the same in the opposite way applies for a downtrend. So you see, we are moving downwards like that. These like minor retracements will always have a little pattern where if you are to draw a straight line, like you can connect all of them. It's giving you the ability to like be able to predict that whenever it touches this level, there is an impulsive move, like the market has been pushed downwards. And what you can do is you can be able to anticipate what's going to happen. So for instance, once I saw that whenever the market touches this line here, it was always pushed downwards. Again, when it touched that level, it pushed downwards. Again, when it touched this level, it was pushed downwards. Again, when it touched that level, it was pushed downwards. Now, let's see, because you only need 3 touches. Now, let's say, once I saw this happen, it is called, and it's the, no, this is the initial touch. It is the establishment touch. This is your entry here. Enter from there. Because to make a trend line, you need 3 touches. To make a line, you just need 2. So once it touched this, it confirmed the straight line was very strong. Then when it came to the third touch, now you just look for candlestick patterns. What we had looked at here. You look for those key candlestick patterns, hence you trade. And here you can come add in more positions and ride this trend all the way to that level. Hence, that gives you some perspective. Then the last thing, yeah, by the way, let me just show you something else. As you are going downwards here, right, you will notice that this level where the market, it's a support level where the market had failed to go past. Show you. Even here, I can draw a line, even right around that level. Okay, you don't need to think of it as a line, just think of it as an area. So what I want to put across is this. Oh, the lines are just too many. What I'm trying to put across is this. Remember what you are from looking at support and resistance. This acted as a support because it pushed the market upwards. Then the market came down, broke that level, came back for a retest, went down, pushed back to that level again, then came down. So now this support is broken, hence it has become resistance here. It has become resistance. The other thing I forgot is if you have a support level, then it's broken, it becomes resistance. If you have a resistance level, it's broken, it becomes support. What I mean is, let me just put things in perspective. Let's say you have a market here moving upwards like that. Then this level is like your resistance level. That's your resistance level. I'm making resistance because the market, it was acting like as a barrier to prevent the market from going further up. But when it was broken and the market came back to that level, this is no longer a resistance level, it's a support level. Same thing applies for a downtrend. Same thing applies for a downtrend. So for a downtrend, let's say the market is coming down like this. And see this level. Forgive my lines. You're that there. Once the market came to this resistance level, support level, it was pushed up. When it broke that level, this now changes to the resistance level, hence pushing the market downwards like that. Hope that makes sense. So this is a form of support, it becomes resistance level. Or let me give another example. Just saying things out. We are all clear. Yeah, so that level there, to this level. Once the market came to bounce on it, couldn't go any further. It's a support level, pushed up. When it broke that level, came back to retest it, it becomes a resistance level because it's blocking the market to move further up. So you can think of support as something that helps you go upwards, resistance something that prevents you from going any further up. Yeah. Once we're done with that, you can now come back to this. What I was explaining is this level was previously a support here, as you can see, but now it has become a resistance level. This combined with the fact that you're on a trend line gives you even added confirmation that this market is going to continue going downwards. Hope that makes sense and I've clarified now. Can move on to, let's see. Oh yeah, the same applies for an uptrend also. This level here to the previous resistance, now tend support here, then support. And what makes this line strong? The number of times it has prevented a move in either direction. So for instance, here we can see that the market was pushed downwards to prevent it from going any further up. It went down. Once it broke that level, the market came back to this level, tested it for the first time. It was strong and it went back again to retest it for the second time. And it was still strong. So this makes this a very strong support and resistance level, or you can just call it a key level, because a support can change to resistance and the resistance can change to support. So you just refer to it in general as a key level. This level here is very strong. Why? Because it has multiple tests. Yeah, so I hope that clarifies what I've just explained. Now we can move on to a ranging market. So a ranging market just means, let me see, is there anything else? Yeah, that's just a breakthrough test. Let's go back. Just trying to see if there's any other important thing we can look at. Yeah, so then ranging market, just as the name suggests, it means the market just moving within a specific range, like here, then here, and then comes back to that level, goes up, goes down. So why is this even important? This is important if you can identify this on the market, because you will notice that every time it touches this level here, the market goes up. Every time it touches this level here, the market goes down. Touches this level, didn't have a lot of momentum, so couldn't reach the resistance level, and pushed down, came back, made like a double top on this level, pushed back down. When it came back to this level, it was pushed back up to that point. No, then from that point, it dropped back down. Now, why is this important? So as a trader, this is important because it tells you in advance, you can be able to anticipate where the market is going to go. For instance, after I see the market make this move, came to this level, got pushed up, and when it comes back to this level, I've seen that whenever the market is at this level here, it's always pushed to the upside. So I've been anticipating that the next time the market comes back to this level, at that point, I'll be waiting to enter the market, and my take profit will be at this level here, because I know that that's where the market is going to end, to change directions from. Hence, this provides you with a take profit, and it's very profitable because it already gives you where to enter from and where to exit from. So I know that if the market goes beyond this level, a little below this, it just means the market has changed direction. It's no longer in this range. So the two main components of a ranging market are just your support level, this here, support level, and the top part known as the resistance level. So the same thing applies for the resistance level. I know that every time the market touches this level, it's being pushed downward. So I'll wait for the second time the market comes back to that level. Look at the candlesticks which it's forming. They give me confirmation together with this level here, since I know that it's a very strong resistance level from the previous candlesticks. That you can see the move failed to break above it. So it tells me that it's a strong level. Hence, I'll wait for the market to come back to this level, wait for candlestick confirmation. Like as you can see, this was a strong rejection of that level. Then you had this engulfing candle, this black candle. Hence, I enter at the open of the next candle. I put my stop loss somewhere around there. Then my target will be this next support level. Hope that clarifies things. Support ranging markets are like among the easiest to trade, but you need to be careful because a choppy market also looks similar, but it's not It's not a ranging market. Like this one. Someone may think this is a ranging market. It's not. What differentiates a choppy market from a ranging market is a ranging market has definite moves that you can see. Like for instance, these are definite moves that you can see. This. Then it goes back down, then it goes up. For a choppy market, it's something like this. It just has so many scattered things that you can't even see the moves. So if you can't see the moves, don't even trouble yourself trying to trade. But if you can clearly see the defined moves like these ones, where they are well spaced, then you can be able to trade and utilize the market. Yeah, so this is just what I was explaining. When the market moves here down to this, you've just seen that it was a rejected area, tested once. Then when the market come back here, there's a rejection. Hence, you know that when it comes for the third time, the fourth time, you're supposed to buy from that level. Then you can anticipate that it's going to go all the way to this level, that red line. Then when it reaches the red line, since you know that it will move in the opposite direction, you close your trade. In short, you take profit from the trade you took from the buys, then you go sell from that level, coming all the way downward. So then the last thing, look at, yeah, when it reaches that level, you don't just sell immediately. You have to wait for the candlestick confirmations. What I mean by that is, remember when we were looking at candles, we talked about different types of candles. For instance, these candles here, they are forming what is known as a morning star. Why? Because you have a bearish candle, a very big bearish candle, then make a more doji in between, then a white candle or a bullish candle, hence forming this morning star pattern. So you can now have further confirmation that this is actually going up. The other thing is just think about dojis. We said where the body is facing, that's the direction of the new move. Why? Because it tells us that the market had been put all the way below this, then it was put back up, meaning that there is a strong presence of buyers on this level here. Then here you can see these are like tweezer tops or tweezer bottoms, sorry. Yeah, then you have that more like a shooting star with a bearish engulfing following it. So you can also use that for added confirmations. The next thing we're going to look at is now the breakout. So the rules that we have about breakout is if the market is in a range like this, the market is in a range for a long time like that, it should definitely break out on what either side. It can go up or down. So when it breaks out immediately like here, you don't trade. And I'll explain why. The market always makes something that is referred to as fake outs. So it will just make a fake out, meaning it's not really, it's just trying to like get people thinking as if it's going to change directions. But in the actual sense, it's going to go back in this range and break out on the opposite direction. So those are referred to as fake outs. So how do you know now that this is an original breakout? So for you to have added confirmation, the market always makes a what? A pullback. A pullback is just the same as a retracement or a retest. Now, that pullback or retracement should always come back. Remember what we have been looking at. We said if a market is moving in an uptrend, right? It's moving in an uptrend, almost certainly it always goes back to the previous resistance level, that level there. It will go back to that resistance level, which will now be called support at this point. So since you have that knowledge, you can now, it will now make sense that once the market breaks out on one side, like here, for instance, it broke out on there, you have to wait for it to come back and test that level. And how are you going to know that this level is strong? Remember that for you to identify that this is a strong level here, that's a strong level. You wait for the candlestick or weak rejections that the market will show you. That's one. You see weak rejections or the candlesticks that we've been looking at, the ones which show indicate reversals like engulfing candles. Also, key candlestick patterns like double bottoms. Then the other thing is you can also look at the number of times the market was either acting as a resistance, where this line, the one that you're currently focused on, how many times did it act as a resistance level or a support level in the past? So then the more the number of times it acted as a support or resistance in the past, the more it's likely that to be a strong level, hence push the market in the new direction that it's forming, in this case, the uptrend. Yeah, with that in mind, now it will make sense that your take profit should be the same as this distance here. But you know, when the market breaks out of a ranging, when it breaks out of a ranging market, it always moves very fast and it moves in that direction which where it has broken out from. So once you wait for the retest, you can even have like 2 times the distance of the range as you take profit. What I mean by take profit, that's the point where you exit the market. So like 2 times that. So maybe one is like reaching up to here. You add another one to go to that level. So around that level is where you exit the market. Should be like 2 times that. You can even make more money by keeping the trades, just like moving your stop loss. But anyways, we'll look at that in more detail in later videos. But for now, hope that's clear on breakouts and how to trade the original breakouts. If it doesn't come back for this retest, you just don't trade. You leave the market to be, because it's most likely a fake out. So let me just erase this, because this retest that we're looking at is what gives you further confirmation. Now let's say, yeah, I talked about shopping markets. Don't trade them. How do you know they're shopping markets? If you can't have like distinguished moves, like the way you're seeing this, compare that to, let's go to where it's clear, this. You can see that here you can clearly see the market going. You can clearly see the market going down. You can clearly see it going up. You can clearly see it going downwards again, up, then down, then yeah, just like that. Yeah, so I think this is, yeah, so in the next class, we'll look at time frames, top-down analysis. This is just analyzing markets starting from a higher time frame going to lower time frame. So you can also do some reading on this to understand it better. But for now, we'll stop here. If you have any questions, you can always ask in the WhatsApp group. If I have time, I will ensure that I attend to all those questions that you might have.